next transaction that we need to look at are the purchases, the money we got from the VE company. So we click on Post. We find, first of all, cash. And the amount of money for our cost of goods sold that was sent to us from VE was $48,913.54. So we want to credit cash 913, or if $48,913.54. Calculate and post. Another one, yes. And the next one goes to purchases. That's where we put items that we want to add into the inventory. You never post directly into the merchandise inventory. So we go to purchases, and we want to debit at that very same amount of $48,913.54. Click our calculate post button. Another posting, yes. Actually, let's do the trial balance and see if we're in balance. And yes, we are. So our posting, it still kept everything in balance. Now let's see. The next step we want to go to is we have some more postings to do. We're going to post cash. And this time we're going to debit cash. And the amount that we want to put in, this is the amount of money that we're projecting that our open house is going to generate. This would be something that would be done in November. So we add that to our cash. And then we also want to call that part of our sales. We come down to sales. And there it is. Open house and trade fair sales. Click there. And the same amount of money goes there. $133,000. And that's just kind of a guesstimate. And so that we can make a little bit of profit in our projections. Let's take a look at the trial balance. Everything still looks okay, so we don't have to back any entries out or do any more posting to correct anything. Now let's see, we have some more postings to do. We have some additional transactions that need to be posted. Let's go to cash again. And we're going to credit cash. For $100,000. This additional transaction is to record the additional merchandise we need to purchase for the open house. You have to have your inventory. We're just kind of playing with these inventory numbers. Later on, if you look at the step-by-steps second semester, you can see learn a little bit more about how inventory is really handled, because we're just kind of using total amounts instead of actual items. And you can see we're still in balance here. Now we have to calculate the ending inventory. That's an important part of doing an income statement. So here's the steps. We add the beginning inventory and the purchases together. That's $100,000 plus the $48,000 plus another $100,000 for $248,000. Now we have to add the sales from the VE contract, $132,000. Sales at the open house, so we have $155,000. To calculate the cost of goods sold, we multiply it times that number percentage we found at BizStats, and we end up with $155,696.77. Subtract that cost of goods sold from the goods available for sale, and you can see our ending inventory comes to $93,216.77. It's better to have kind of a little bit larger inventory so that you know things are covered when all different things come up. Now we're going to produce our financial statements. So we see that we're still in balance. We want to click on the tab for Income Merchandise, display the income statement, and here's where the ending inventory needs to be added. We put this in once before to calculate the beginning balance sheet. So here's the number that we calculated for our ending inventory. This method is called the gross profit method. There's other ways of doing it, but this is one of the easier ones. So you can see we made a net profit of $4,334.90. So that's pretty good if that was our first month. So that's kind of our projection. We can revise that if our sales were either more or less. Of course, you can print these statements out. Back in the trial balance section, we showed you how to print out those statements. Click on the Stockholders' Equity tab, and you can see that the net profit gets added into our stockholders' equity. So that increases our stockholders' equity by the amount of the net profit. Had we had a net loss, it would have subtracted that number. Now let's look at our balance sheet. Click on the balance sheet, display the balance sheet. It says a year-to-date file has been updated also. The program makes a year-to-date file in addition to a monthly file so that you can keep track from the whole thing. It says you're in balance, and you can close the books. So we're going to close the books. And it makes a file called merchandise close text. That's what you're going to use next month when you start processing your statements.